got a real doozy here, probably considered on like a month by month calendar, the biggest, I would say, binary event that just like touches all markets, which is the FOMC meeting or the Fed meeting here in the US. Binary events include earnings announcements, but those are individual stocks. It doesn't really shake up. An earnings announcement ain't going to move interest rates and foreign exchange and metals and everything else. You've got non-farm payrolls. That's a really big one. First Friday of the month, that's your unemployment rate and your change in payrolls in the economy there. And that's a big one. That's going to move equity indices and interest rates and a few other things. But the Fed meeting 10 times a year, they come out and they change rates, or they don't change rates. They go to the short-term barometer, short-term benchmark for interest rates in the US, and they say, we're hiking or we're cutting or we're leaving them unchanged. And then what's almost always more important is they give you projections and they speak on what they see happening down the line. Like the Feds recently under Yellen and Powell now are very calculated. And by the time they do hike or they do cut, they have shown you that it's coming. And so that press conference after the event today is going to move markets around, because that's when people are shifting like, oh, they're going to hike by the end of this year, or, oh, they're not going to hike for another year or so. So a really big binary event. I mean, are there any other binary events that you can think of before we dig into this one?
Yeah, I guess specific to like oil would be EIA numbers, which are released on a more frequent basis. OPEC meetings are another event that kind of move oil markets. In crypto, you have like a coin being listed on an exchange, but there's not like a lead up to that event. And then you have like hard forks and soft forks, which will sometimes impact prices a bit. But yeah, I'd say the biggest one is probably FOMC, because it moves interest rates and stock markets, and also kind of tertiary currency markets, which are directly tied to those rate markets. So
absolutely. And so what we're going to do today is use this FOMC event that's about to go off in the next hour or so as an example of how to trade all these other binary events as well, in terms of like an outright trade using futures or stock shares or what have you. And so the first thing you do is you look for an event. Now, there are events every single day if you want to look for them. There's a stock that's announcing earnings, like Mikey says. There's a crude oil inventory. I think there's 2 per week. There's grain inventories that are monthly. So many different things that if you want to trade binary events, they go off almost every day. But this is a really big one, and the ones that occur on a less frequent basis are more likely to move the markets a lot, whereas crude oil has inventories twice a week. And so every one of those numbers, since we're very well informed on the supply of crude oil, because it happens every week, it's not going to really shake things up unless it's a really weird number, And so today is the day, September 22nd. We got our event here. Next step is like, what does this event do? What does it touch? And so the event today, like I said, they're going to say, we're hiking or we're cutting or we're not doing anything. And recent Feds have been very, very predictable. And so the event almost isn't in the hike or the cut. You can see this is the dot plot, Mikey. I know that us millennials maybe are not super acquainted with this thing that's been around forever, but do you want to give your millennial viewpoint of what the Fed dot plot is?
Sure. I'm barely a millennial, but I'll take it. 96. So on the x-axis here, you have years. Those are expectations of basically where Fed members expect interest rates to be in the given year. So 2021 here, holding in at 25 basis points. And I guess maybe we can set a little bit of context here. So the Fed targets a range. They target basically a 25 basis range, so between 0 and 25 basis points, or 25 and 50 basis points. And the way they adjust that rate is through open market operations. They're buying and selling treasury debt from and to large institution banks, member banks who are registered with the Fed. But yeah, you can just pick the base number, 25 base points here. But as you can see, you move across that x-axis from the left to the right, the range or the variability in expectations widens. In 2022, you have some people expecting rates to be 25 basis points, others expecting them to be 75 basis points, or it looks like you almost have kind of like an average there of around 30 or 40. Moving out further in time, you can see those expectations widen even further, leaning out to 2.5% in the next few years. In the longer run, they define it. They don't even set a date there. But yeah, it's just to kind of forecast and telemark where they expect rates to be going forward. And this is all part of an effort of the Fed increasing their transparency. Back in the 1980s, when Alan Greenspan was Fed chairman, he didn't have any of this communication. He would basically just jump in front of the camera and say, we're cutting rates today, or we're raising rates today. It would have a huge market effect. Now they're trying to release these publications to show the public and provide forward guidance where they expect things to go, so companies can plan.
And I'm glad that you bring that up because that's a great example. And also, this information it's good for context. It's as you're about to see here in how we trade binary events, it factors in nothing at all to what I'm going to do today. Like, because if the idea is that you're going to watch the press conference and you're going to see them speaking with probably what's like a 30 to 60-second delay, or if your internet or your stream is even slower, like a couple of minutes of delay, and you're going to go from that to buying or selling in the market, you're going to have a rough day. And so waiting for the information to come out and having that inform a trade is really rough stuff, but it's great context. First of all, from that example that you posed, yeah, they used to come out of nowhere and cut or hike rates, and the stock market and interest rate markets would go crazy. Now, since they are more calculated and they do give you these dot plots and everything else, it's almost like if the stock market was going to move 10% off of a cut or a hike, and they did it just like that. Now with this, they'll let you know, over the course of 2 or 3 meetings, but the stock market will move, 2 or 3% at each of those. You know what I'm saying? It still is the same amount of movement, but it's now just placed over multiple meetings where they adjust these projections. And so essentially the context that you have here going into this binary event is interest rates are at 0. They look like they're going to be at 0 for the rest of 2021. But in 2022, they're pricing an average of getting up to, 30 basis points or 40 basis points. And by the way, a basis point is just 0.01%. And so 1 full percent is 100 basis points. So by the end of 2022, they're saying, oh, we might be around 50 basis points. Right now, we're at 0. And the 2-year treasury that we're going to look to trade here in a second is at essentially 23 basis points. And so by the end of 2023, they're averaging about 70 basis points, up to some people projecting, 150 basis points, 1.5%. And then in the longer run, that thing doesn't change very often. Most Fed chair people think that, short-term rates in the long run should be between 2 and 3%. And we actually did get up there, as right before the pandemic. Short-term rates, it may seem to people like, oh, they never get that high. Right before the pandemic, the 2-year was showing a yield of close to, I believe it was like 2.5%. So like they get up there in terms of these rates. Right now we're at 0. And so all that context, Mikey, lets me know that they're not going to cut or hike today, but yields are going to move either higher because they said, oh, we're projecting more hikes, or we're really thinking we're going to hike in 2022 or 2023, or yields are going to move lower. Rates are going to move lower if they come out and they say, actually, we have to move our projections down for 2022 and 2023. So that's the context. And with all these binary events, you want, like the same with earnings, where it's like, okay, this is the number, this is what they did last time. And if they, beat last time, did the stock go higher? Most likely, yes. And so when I'm going in there and I'm trading the stock, I don't need to digest the information to know like, oh, the stock's a lot higher. That probably happened, but I'm already trading it. By the time you digest that information, it's gone. Now, the next thing you want to look at is what markets are likely to move from this event. And what I have here is kind of a hierarchy in terms of this event. Now, with like the inventories, like Mikey said, it's going to be crude oil. And then that's pretty much it. Maybe the byproducts of crude oil, like jet fuel and
stuff like that. Yeah.
Exactly. With FOMC, they're touching rates. It's going to be rates, the first thing. But maybe you can speak to what rates kind of affect there afterwards, Mikey.
Sure. Yeah. First thing that I just really want to touch on quickly, you said, is the best way to see what the decision is to watch the price. It always befuddled me as like, wow, Apple made $10 billion in profit this year and they fell on the earnings release. It has nothing to do with the actual number, but it's deviation from expectations. If people were expecting 11 billion in profit and they underperformed, it's probably going to sell off. If they were expecting less and it outperformed, it's probably going to rally. Similar with all these binary announcements, because there are hundreds of thousands of analysts who are researching all this and running their own models, et cetera. But best way to see it is just directly in the price. So when the Fed goes out and says, yeah, we're going to keep rates steady for the foreseeable future, inflation is starting to pick up, we're monitoring it closely, and the unemployment rate is reaching stable employment, blah, 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 all these buzzwords that they throw in there that they really always mention in every release. Yeah. First thing that's going to be affected, short-term interest rates. That's exactly what they're adjusting. They're adjusting the Fed funds rate, which is the rate at which larger institutions borrow and lend basically to each other and to and from the Fed. Off of that is going to be more medium to longer term rates. Remember that interest rates in the yield curve have kind of like a whip effect, or when the short term rates move higher or lower, it's also going to be reflected across the medium, the belly of the curve, the 10-year, and then the end of the curve, the 30-year interest rates. Now, why does that affect foreign exchange? The general macroeconomic belief is that higher interest rates in a country mean people are going to sell out of their other currency and move into that high yielding interest rate currency to buy debt yielding assets in that denomination. So if rates rise in the United States, you may expect euros, pounds, Aussie dollars, Canadian dollars to sell off as people move into United States currency to buy that treasury and collect the higher yield.
And vice versa, right?
Yeah. And vice versa. Sorry, everything should be explained as one or the other. Equities, very similar case. It's going to be related to foreign exchange because a lot of multinational companies are dealing with pounds and euros and Aussie dollars, et cetera. But also it's going to affect their cost of funding because companies issue debt like Apple. They have basically AAA rated debt instruments that are listed for purchase by institutions. That's going to affect the rate at which they can raise money. And then finally, commodities. I guess my inclination, Frank, and my kind of layman's explanation is going to be that it's affecting like cost of carry or transportation or also the financing costs of companies related to that.
So equities and commodities are at the end there, and they're kind of tied for the end because they're just going to have knee-jerk reactions one way or the other. Like I could make an explanation right now that if they said they're coming out and they're hiking like mad over the next year, I could make a case to be bullish equities and I could make a case to be bearish equities. Same with, I mean, gold, it's actually kind of more straightforward. Gold should probably move lower just given that it's a non-interest bearing flight to quality asset. And so people would probably dump out of their gold to buy something that's going to be more interest bearing flight to quality asset like U.S. Treasuries. But those equities and commodities, there's no real rhyme or reason. Like you'll see moves in both directions, which is great for what we want to end up getting done here, which is just like we want to trade movement on a binary event. You want to trade price action. You basically want to say like, I know that this market usually does this on a given day. Now that it's a binary event, and I know the particular markets are rates and US dollars and kind of equities and kind of gold there, I know what they normally do, and I'm going to put in bids and offers outside of what they normally do. And here we have the SFX, the small US dollar, moves about 40 cents on a given day. Small 2-year moves about 15 cents. 10-year moves about 40 cents, 30-year moves about 40 cents. So everything is kind of in the 10 to 50 cent range for those products. Knowing that, I'm going to go into the market and see where everything is. And I'm going to say to myself, okay, well, I'm selling US dollars 50 cents higher than this, and I'm buying US dollars 50 cents lower than it, just so after the event comes out, There's hopefully a knee-jerk reaction, but at the end of the day, as long as they don't come out with their hair on fire and stuff is going crazy, the market should kind of reverse a little bit in the hours after, hopefully just the minutes, but the hours after the event. And thus I bring up this market here, and I'll look at the 10 years is kind of where people like to go first, and it's probably the most basic. And you see it here at 1330. And I just showed you, Mikey, that the 10-year moves about, 40, 50 cents. So at 1330, I'm putting in an offer, or I guess 13 and a quarter, 1330, whatever you want to call it. I'm putting in an offer about 50 cents higher. So I'm saying, all right, I'm willing to sell this market at 1375. And that's way out. I'm not going to get filled, obviously, but I'll ship that order off at 1375 and know that it's there. And if I get dinged, I got to be ready for my mechanics. And my mechanics for today are probably like, all right, I'll look at 20 or 30 cents. That's what I'm trying to make on this trade, about half of what the move is. And so if I sell 1375, I'm going to be ready to buy back. If it gets above 14, then I've lost. I'm done. If it gets back to 1350, I'm taking my profits and I'm going home. And same on after shipping this order out, I'm going to do the same thing with buying 10 years way below the market, about 50 cents below the market, which is going to be 12.75. Now, I can also insert a little bit of my bias. Right now, the market's not expecting rates to go higher. So I might move this actually to like 85, given that this market is beat up. I'm a little bit more willing to buy than to sell. So I'll put that a little bit closer. And of course, I'm not going to get dinged on both of these. If I get dinged on both of these, it's a great day, because that means that I sold 50 cents higher and then I bought it almost $1 lower. But that's essentially the idea here. And what's really nice is that you can go across to SFX, do the same thing about 40 cents away, and then you can go to metals knowing that they move about 70, 80 cents and be like, all right, they're at 70. I'll put an offer in at 71.5 and I'll put a buy order in a little below 70. Same thing with stocks, probably closer to 80 cents to $1 away. Do all of that going into the binary event, and that's your setup. Just make sure that once you get dinged on those trades, if you have entries all over the place, you got to be watching them. And once you get dinged, you have to be saying to yourself, all right, I'm ready to get out at this price for a loss and this price for a winner, and I'm trying to get out by today's close, but next 24 hours are my time parameters as well for day trading a binary event.
Awesome. I love it, man. And it's very common to see, I think we have seen historically, especially going into these kind of non-event binary events, that you will get a whipsaw and the thing won't just rip to the upside and trend higher for the rest of the day. I think when you have low expectations here, it's more common to get that back and forth action, just as people kind of freak out around the news. Like once the news is out of the bag, it'll kind of settle itself after the fact, but you generally have this slow creep going into the binary announcement and then kind of that upward down swing. I think trades are great there. And you can actually, in the active trader section of the Tasteworks platform, very easily adjust those bids and offers as well. So if you want to trade something a little more fast paced, like an earnings announcement, I know that's for after market close, you can do that in the platform as well.
Absolutely, Mikey. Thanks so much. Yeah, the idea is just essentially like one time out of 10, something really big is going to happen and you're going to lose. Maybe a couple times out of 10, I shouldn't make it that unlikely. But most of the time, there's going to be a big reaction and then not a lot has changed. And that's what you're hoping for when you're trading mean reversion like that on a binary event. Mikey, thanks so much. We must get to splash into futures next and set up some of these trades going into the FOMC. It's coming very, very soon here. Thanks so much for joining us, Mikey. And thanks everybody for watching. See you in a little bit.